Hi everybody, so I'm going to have to bear with me a little bit today. Number one, I'm only just back after a month off, which has been great. So just back to the swing of FX Street webinars, which is great. It's really nice to see you. Thank you so much for joining. The other reason, I have got a bit of a cold, so I've got a bit of a sore throat at the moment, and I'm also sneezing. So do apologise if I'm taking intermittent breaks. It's probably because of that. I'm hoping to have it all cleared up so that then I can go and hopefully anyway, but for next week I'll be perfectly fine again, but do bear with me, and many apologies for that. So, just to start things off, really, what we've been seeing is a bit of, obviously, since January, since the beginning of the year, we've seen this huge kind of breathless run up higher in risk, which we've seen the last few years. But we tend to think that there's some big fundamental questions now in the pipeline that need to be answered before we can really move forward. Obviously what we've had is, dollar yen being a huge mover. I'm going to go into that. As you can see, that chart up there. Has the Bank of Japan been ambitious enough in its easing prospects to really get the Japanese economy going? We're going to have to wait and see, but we're really seeing, for a very long time now, we've had these unifying themes across asset markets, whereby we've maybe gone risk on, risk off, or we've gone carry trade, or something like that. Well, we don't seem to have them anymore. The FX market very much looks like it's moving more of a random walk, which is going to be pivotal. It's going to be pivotal to 2013 gains. Guys, it's going to be pivotal to the types of trades you put on. It really is, central banks, again, they've come into the fore. Is the Eurozone crisis going to remain as stable? All of these things have helped drive risk higher. Likewise, all of these things have had huge impacts just on certain asset classes as well, like dollar yen, as I was saying, like euro dollar. But are they enough now to drive us further? To continue to drive us higher? Now, what we've seen really over the last just over the last couple of days has been a kind of very much I would argue, over the last, say, week or so, and we have seen, we have seen kind of pullbacks. We haven't seen changes in direction. The market is pausing. It's taking its time to think about what to do. It's taking profits. That's kind of, that's the place where we are now, and why not start here? This is where we're seeing it. This is dollar yen. This has been this is the hourly chart, so a very short-term chart. We obviously had the Bank of Japan out overnight. Had the Bank of Japan out overnight. They were dovish, you could say. They did raise their inflation target as expected. They did say that they would do open-ended asset purchases, but not until next year. Now, that is really pivotal. That's kind of the pivotal thing that we're talking about here. The pivotal thing the market was looking at. In that sense, it was probably less dovish than expected. Hence why we've seen the market, the dollar yen, being very, very sensitive to what's been going on in Japan and with the Bank of Japan, and we've actually seen the market sell off. So to put this into some context, let's take a look at a slightly longer chart. So as you can see, that huge run up since mid-November, so really done incredibly well, kind of jumped, good 10 big figures, even more since then. But we have come off, we have obviously backed away. Now today, we did break through that 89.15 level, which is now a really key resistance level. It was an important short-term support level. Let's just go back to the short-term chart so I can tell you. And that is the 200-hour moving average, so the red line in this chart. But if you look here, that break below kind of 88.70 really took us into oversold territory, and we have started to pick up from there. So there is very, very good support at 88.50 in this cross. So looking at it purely from a fundamental and technical basis, one could say that the market's kind of almost kind of bought the rumour, sold the fact, hence why we saw that sell-off in dollar yen just over the last couple of days. But from a technical perspective, that sell-off does seem to be moderating in the short term anyway. So we've seen a bit of a pickup around about that 88.50 level, or certainly some buying interest. Now that to us means that short-term bottom has been put into play. Now from the upside, 90.15 looks like the short-term top. So right now we think that's going to probably range bound. As I said, when we do get into these oversold conditions, as you can see here, with that MACD really, really dipping into oversold territory, it can tend to be a bit of a lagging indicator. But I think in this kind of environment, it does a good job of telling us overall kind of momentum and sentiment in the market. So it is worth kind of watching. But just a few levels, and to put things back into kind of perspective, into longer term perspective for us, we probably won't have seen the end of this upturn unless we break below kind of 87.80 to 70 to 80. That is the 21-day moving average. That's a really, really key support level on the downside. Some slightly negative things that we're seeing at the moment. We have seen that negative crossover there on the daily MACD. That just suggests maybe on a longer term basis, people are kind of stepping back. Be very normal after 6 days of losses, after kind of 6 days of going nowhere, really, not pure losses. I'll show you more about pure losses later. But as long as 87.80 does remain in place, as long as that 21-day moving average does remain in place, then I don't think that bearish MACD should just be used on its own as a more kind of long-term short position in the dollar, in dollar yen, because I think that there are other there are other drivers, there are other technical signals that also need to be respected. So I think that there could be a lot of buying interest around about that 87.70 87.70 if we were to fall down to that level, which we may not do. Sorry guys, that was kind of unfortunately one of the side effects of me not being 100% better. There's all this snowy weather here in London. So that to me is the key thing. If we can get above 90.50, then that really opens the way to kind of 94.15, maybe then up to 95. And to get back to those levels, we really need to look at a monthly chart, so going back an awfully long way. So, the move that we've seen already, that takes us back to kind of 2010 highs. This is really significant. This is multi-year stuff. When you get multi-year stuff, you really do tend to see sometimes a little bit of pullback. So this is the monthly chart on a monthly basis, still looking like it's very much on an uptrend. Nice rounded bottom there, bullish signal. From the weekly chart, though, that does suggest, there's just a little bit more volatility in this trend than one would think, but that does tend to be the case. I mean, on a weekly basis over the last kind of 2.5 years, we haven't really moved very far. We've been stuck in a range, as you can see there. So this break high that we've seen since November last year really has been unusual. It's been breaking out of a paradigm, and when that happens, it would be very normal to actually see a bit of a pullback, even on a weekly basis. So right now, as I said, it's the 87.70 level. That's a key support. That's the 21-day moving average, that we're looking at. Now, the other thing, why not start with all the weak crosses? But we've seen cable. I was on Bloomberg yesterday, and they actually quoted me, or had me on in a big headline as saying that cable was the pound was the sick puppy of the FX world, and I stick by that because the pound is looking so weak. I mean, this is a weekly chart in the pound, and again, you're just putting the recent moves. Those of you who've been trading the pound will know just how volatile it's been, to say the least. And it is still trading within its range, but over the last kind of two odd years, it has slowly been trending lower, and that that failure to break above 163 again does just shows that there's a very long-term double top in there that's gonna thwart the bulls, really. That's what that means. And we've had, you know, some very sharp moves lower last week, so it wouldn't be abnormal for us to see a little bit of upward pressure, but especially because we are still trading in a range. Let's go back. Let's take a few steps back. This is the daily chart. So as you can see there, obviously the break below 159.30, the 200-day moving average, a very bearish development for this cross, but we have found some very good support ahead of 158. You really, you know, as I said, like kind of this 155 mark, even going back here, kind of 154, 153 is the bottom now. I think that, you know, the speed at the move, the speed at the sell-off that we saw last week. Some people say, well, you know, oh, that means that we've gone too far too fast. Well, the one thing we would argue is that the pound can fall very, very sharply, very, very quickly. And has a track record of doing that. Let's go back to the monthly chart here. Look at how sharp that sell-off was for, you know, a good 6-7 months over 2008, 2009. So in the peak of the financial crisis, we did see the pound really lose its grip, and so it has got a history of being able to sell off very, very quickly. It is below some monthly moving averages there, which suggests that we've potentially gone into a new kind of trading pattern for this cross, whereby the momentum very much to the downside. And we've seen kind of a lot more selling pressure. So there still are net longs in cable, according to the CFTC data, which measures kind of speculative interest in the pound, but they are falling rapidly, and as that support dwindles, then we could see further downside. Now, we've got some important economic data coming up this week for the UK. Tomorrow, obviously, we've got the UK minutes, and we've also got labour market data, but the big release will be that Q4 GDP data, the first reading due on Friday, 9:30. That's where you want to be. That's where you want to look at if you are trading cable. The market expects a fall of 0.1%. What we've seen in the past is that these advanced quarterly GDP figures can have a huge impact on cable and its crosses, or sorry, on sterling and sterling crosses. So do watch out for that. Any negativity or any kind of data miss whereby it's economic data is worse than expected, let's just go back to that daily chart, could really see us fall through the floor, maybe even get to that 157 level. You know, we are bearish, obviously, that 158.30, which is kind of where we are now. That's important support, so it's no wonder that we've bounced off it. But a daily close below there would be very negative, which could take us to 157.55 and then back to 157-ish, or just below 156.95. Key resistance still is kind of around about that 160 level. If you look there, 160.20, that's the 100-day moving average, which is the yellow line in this chart. Again, starting to look a little bit oversold, I would say. However, when the markets really get going, they kind of sometimes ignore these kind of momentum indicators, especially when it comes to cable, because as I said, there's a history of these very sharp economic sell-offs. What else? Well, you know, the other place where we've seen a lot of weakness, just looking at this kind of theme of what's strong and what's weak in the currency markets. Let's look at Euro-Swissy, because that really is kind of worth watching. As you can see, Euro-Swissy had got as high as 125.50, but since then it did sell off. Apologies again. Since then, it has sold off, and some people are quite worried about the future of this. I think some people saw that move to 125 as being kind of the finally Euro-Swissy breaking out of its range and just having a wonderful trend. Well, I think what the market behaviour over the last kind of few days or last week has showed us is that, you know, no trend is going straight up. We've got some important questions to ask. The euphoria of the last kind of 4 weeks may be coming to a slight end, and the markets are actually looking more towards what's been going on a fundamental level as well before they take the next move and get the next kind of leg in this rally. In that sense, Euro-Swissy does look a bit neutral at the moment. Resistance is obviously that kind of 125.50 to 126 level. That is a very positive move. If we can get a break above there on a daily or a weekly basis, that would be very, very positive. But support, it lies right now. We're kind of very close to support right now, around about that 123.50 level. As you can see here, that is the 19-day moving average. Sorry, I know it's not the best one to look at. It's a bit short, but that is kind of really key short-term support here now. As you can see, we're seeing a flattening off in this MACD. Well, that's really happened already, but it's just showing everything's kind of in line. We haven't quite collapsed on it yet, which does suggest that maybe we're just flatlining. Maybe momentum hasn't fully been done, but if we do break below that 123.50, then we could see a bit of a sharper fall back to that 122 level, which is where there's a whole layer of incremental support. So it does suggest maybe you're a Swissy at the moment that we've gone too far too fast, and that could have implications for the rest of the market. That yes, we've moved high, yes, we had that huge move higher, but maybe it was a bit of a false break higher in some of those crosses, which is kind of worth pointing out. Now, I just want to show you euro pound as well, because right now in the markets, where is the strength, where is the weakness? One could argue that we should be able to see strength or we have seen strength in some of the crosses in, or some of the emerging market crosses, emerging market currencies. They probably, their economies are stronger. They don't need to have as loose monetary policy. As people take their money out of Japan, they might want to keep it in Asia, so it may be good for Asian emerging market currencies. Added to that, that would be one of the key things. But in terms of the kind of the G10 or the G4 even, euro pound has really broken out of the paradigm, as you can see here, and continues to push higher because the pound is still weak, remember. Looking at it from a very short-term basis, we're getting a bit sticky as we get towards that kind of 84.50 level. But the weekly close, let's just get back to the daily chart. That break above kind of 84 is a very bullish development for this cross. So we still remain quite bullish for it. We're still bullish euro dollar, for example. That's another reason. It's posting kind of new highs, a break above. If we continue to remain above 84.20, that would suggest that we could move forward then towards 85. Support continues to lie around about that 83.50 level. So just this resting level here on the daily chart. So looking at it on an hourly basis, again, we're managing to hold fairly good gains, managing to hold on at the moment to that 84.20 mark. Nothing to point out at the moment that we could kind of fall through the floor. Again, between kind of 84.15 and 83.95, there's very, very good short-term support. Look at all those moving averages there. They should all act to kind of protect the downside, so that's certainly worth watching. The other thing that I wanted to show you, obviously I'm going to look at euro dollar now because I haven't, and then we're going to take a look at some stock markets, if that's all right for you guys. But let's take a look at that. I mean, very, very choppy price action, and that's what we've seen over the last kind of few days in this sell-off. So it's been very, very choppy. One moment it's been falling through the floor, getting below 133. The next minute it's been rallying again. Had quite a strong rally, quite a strong recovery just in the last hour even, since kind of European markets have opened. Obviously this kind of 133.80 to 90 level is really, really key resistance in the short term. We have had some economic data that was better than expected. That's been one of the reasons. Going forward, certainly in the next kind of 3-4 days, we've got PMI data coming out of the Eurozone for January on Thursday. That's going to be a really key level or key data release to watch, because it is the first kind of main January indicator. If we can see continued improvement, albeit from a low level, then that could really help help euro to recover against the dollar. But overall, the more important thing that's affecting the dollar, the euro dollar rate. Let me just take a quick look here. Is this De facto tightening from the ECB. The balance sheet in Europe has been shrinking after reaching its highest ever level in July. Since then, it's actually been coming off. Obviously, the ECB hasn't been buying any purchases. The OMT hasn't been triggered. Added to that, we've had some paying back of those LTRO loans. All of those things, continuing to kind of weigh on the balance sheet. Obviously, the ECB also very keen to sterilise and not expand their balance sheet. So they've been doing exactly that. As much as they've been talking the talk with the OMT, they really have done nothing. And the OMT has proven itself to be a fantastic signalling tool. Well done, Mario Draghi, in that sense. So we have seen that tightening, and that is compared to this. So the Fed balance sheet the ECB balance sheet is shrinking. Fed balance sheet continues to move higher. And what does that mean? That should be stronger. That should mean a stronger euro, because remember, size of balance sheet has an inverse correlation to what the currency is doing. So that's really important. Now, before I move on to stocks, I don't know if anyone's got any questions. If you do, feel free to write me your question in either the Q&A box or the chat box. Anyone got any question? Please do ask. Let me know. Otherwise, I'm going to say that you're all eager to hear about stocks. So I'll give you one moment to just jot a question down if you have any in your chat or in the Q&A box. I know there's two there, which can be a bit important. Oh. So Ray doesn't have any questions. Thank you for letting me know. The rest of you, if you do have questions, save them up and I'll jot them down and I will get to answer them. But I wanted to just show you something about stocks. Obviously, I'm going to look at the S&P first. Purely because it's kind of like that global gauge. Obviously, US markets were closed yesterday. We've seen European markets fall today. But again, they have been a little bit directionless, but there is some important things coming up. We've obviously had earnings season come up. Someone's just asked about cable. Well, I did speak a long time about cable, but I will ask that in a minute. Effect on balance sheet of US on Aussie dollar. That's kind of an important one. Okay, so I'll go back to those two questions in a minute. Okay, the S&P. Just looking at it, it is obviously very important. It's one of the kind of big indicators, and really nice uptrend there since mid-November, along with kind of the dollar yen. So moving higher. Stocks really have led the way. Let's go back to a 5-year chart. Stocks are close to multi-year highs, their highest level since 2007. Can they extend these gains or not? Well, earnings for Q4 have been pretty good overall, especially for things like the banking sector. GE, for example, big bellwether companies have done well. But we do have Apple earnings tomorrow, and Apple obviously being such a big company, they've had their stock price really battered the last few months. If they have a miss in earnings, then that could just freak the markets out a bit and actually cause a bit of a moderation in the S&P, we think. Obviously, we broke it, 1500 looks like it's beckoning there. 1450, obviously very, very good support. Now, that's the same with the Dow. Let's take a quick look at the Dow. Again, broken above that key level. Now, back at levels not seen since 2007. And for those of you who follow Dow theory, don't worry if you don't. But basically, there are some sub-indices within the overall global indices that are considered leading indicators. And the transport sector of the Dow is supposed to be a leading indicator because it shows things like, because it just basically shows kind of the feverishness of economic activity, because that's how fast things are moving across the country. And as you can see here, transport is still looking very, very strong. I mean, had a fantastic rally, really broke out of its annual range back in very early January, and that does suggest that there could be further upside in stock. So we have, as I mentioned at the start, we've seen stock markets and the FX market really diverge. So just because of certain things going on in the FX market doesn't necessarily mean at the moment that it's filtering into stocks. How it's important for the Dow theory is that we do tend to see how it tends to have an impact on Dow theory, is that we, or how Dow theory works, is that you tend to see bond yields, if bond yields start to rise, that weighs in commodities, which then puts upward pressure on the dollar, which then should weigh on stocks. So in the cycle that we're in now, if bond yields in the US continue to rise, they've actually moderated a little bit over the last few days, but if they are on more of a longer term trend higher, like some people think, then what we could see is commodities fail to do well, and eventually that to start weighing on stocks. But that could be in a few months' time rather than right now, and we wouldn't expect it to happen all at the same time. We would expect stocks to be impacted last, if you see what I mean. Certainly not now. So great. So that's my stocks. That's why we're quite bullish on stocks, and you can put what we've learned here to other markets as well, to other commodities, to other stock indices in other parts of the world, purely because the US is a real bellwether globally, and also because stocks, if things are going well in the US, then that is good news for global stock markets. And obviously part of why we've seen stock markets do so well is because of a little bit more certainty going on in Washington. We missed the fiscal cliff, obviously. That's good news for US growth. Added that, the debt ceiling, even though it's not been solved, we're not going to default over the next kind of 3 months. There's a chance that Congress may be able to act a little bit more or less childish. So, someone mentioned about the German data and why that's affected the pound. Now, the reason why, let's take a quick look. And that German data was the German ZEW, much stronger than expected. Look at that. So, this was one of the first rises actually since May, but it's the expectation index. Yeah, exactly. Strongest level since kind of mid-2010. I mean, that shows a real turnaround. Very, very good news. Let's take a look at what cable's been doing since that's been happening. Cable's kind of rallied a little bit. On the back of that, that's probably good news. It's always good news when your trading partners are doing well. Also, let's take a look at Euro sterling. That's also rallied. So, one would expect that to have a very good, because the markets are looking at fundamental data. You do have to look at data out of the major economies, which is Germany, the UK, obviously stuff out of Japan, out of the US. You don't want to forget China in that. And then, that would be kind of one of the main reasons. Now, in terms of sterling, we still tend to think that sterling could get hit quite hard in a very short-term basis. As I said, that 158.60 level is key, but certainly for cable, 158.20, we've managed to break back above there. If we can stay above there, that's fairly supportive in the short term, maybe for another retest of that 159-ish level, maybe 158.80. But if we do get a daily close today below, if gains cannot be sustained and we get a daily or a weekly close below 158.20, which isn't beyond the realm of possibility, then that would really open the way for 157.50 and then 157. Someone asked about, let me just double check here. Someone asked about Aussie as well and how. What was it? The effect of the expanding US balance sheet on Aussie dollar. Well, Aussie has been really interesting because, as you can see, it's been moving higher. So that suggests that, but it really has been stuck in a range. So in the very short term, moving higher, but it has been stuck in a range. Failed to get above that 106, which leaves me quite neutral on Aussie dollar. I think, we've managed to be, what it shows us here is that we've held very good support between 104.50 and 105, but 106 10 is really acting as key resistance level. So I'm not really interested in Aussie until we get above or below one of these levels. That to me is too choppy, a range. There isn't really anything going on. There's no clear direction. So for me, I'm keeping out of Aussie at the moment. I think there are other trends to be had, but I think if a clear break of 106, and I would probably buy it, and a clear break to the downside of 104.50, and then I would sell it, targeting maybe a move back towards kind of that 103.50 mark first initially, and then back towards kind of even 101, which was the low here, as you can see, from October last year. But it's 10:30, so I'm kind of done here. I am happy to answer one more question if anyone would like one. So please do let me know if you have any questions. I'm happy to take one more. But if not, thank you so much for joining. We do have our Forex.com website webinar tomorrow at 10 o'clock as well. You can register for that on our Forex.com website, sorry. Other than that, well, welcome back. Happy New Year to you all. Thank you for sticking with me and coming back after my month off. But it was good. Apart from the fact I'm a little bit ill now, I feel quite creative, which is nice. But anyway, good luck trading to you all. Thank you so much for joining. Thank you for your participation and your questions. And I do hope you will join next week. Thank you.